welcome on in. This is Lowcountry Money Talk. We've got lots of questions, and our friend Phil Bloyd is here with lots of answers. He's from Revolutionary Financial Group, back with some great advice.
Yes.
Nice to see you.
Nice to see you, Jessa.
So we've got a fantastic episode ahead. A lot of our viewers having questions about Social Security, and we're going to provide some answers today.
Sure.
You know, Phil, I think a big question that people have, or maybe people are generally even unaware of the fact that when they start receiving Social Security, it may be taxable. Walk us through that.
Sure. Well, the government has something that they call provisional income. And that's a formula to determine how much of your Social Security may be taxable. Now, unfortunately, you know, when people wake up January the 1st of a new year, it doesn't, dawn on them, hey, my Social Security is going to be taxed possibly, so I may need to set aside some more dollars to cover that.
Yeah, and that's an important factor, obviously, if you're budgeting and trying to make that money last through retirement. Sure. So let's talk a little bit about how the IRS determines taxable Social Security. How do they decide who gets taxed what? Sure.
Well, again, provisional income. So they're going to take a combination of basically everything that you earn. And any 1099s, W-2s, even municipal bond interest counts on there. But there's a formula to determine all that.
So you actually have, and viewers at home, you can do this with us or write this down and do it later, but you actually have an exercise that folks can do.
Sure.
We're not talking about squats or curls or anything, I don't
Well,
think.
that's good too.
Yeah. So what is
Maybe they do that while we're doing this.
Yeah,
so we can do that at the same time.
2 birds, 1 stone.
Yeah.
But this is an important thing for our viewers to understand, that you can actually start determining what that taxable income is going to be, what that percentage is, based on this exercise.
Right. The first thing I would say, if you haven't already, go to ssa.gov, set up your account. If you're not receiving Social Security, go in there. They'll ask you a series of questions. You can set up an account. You can go back and look at the first dime that you earned according to the Social Security Administration.
Wow.
And they'll also have on there, your benefits, whether it's, at age 62, if it's full retirement age, or at age 70, and it'll tell you how much your Social Security is estimated to be. So you want to do that. So if you haven't started already, of course, if you've already started, then you know what your benefit is. Yeah. But so first of all, you can take out a piece of paper, join us for this little exercise, get your sneakers on, and do some squats while we're talking about it. Hey.
Sneakers and your pen. You got to get it all down.
So the first thing we want to look at as far as provisional income is 1/2 of your Social Security itself. So if it's a joint return and as a couple, you're getting $40,000 a year in Social Security, half of that, $20,000. So that's what you would write down first, $20,000.
Okay.
All earned income. So if you're still working, you draw a W-2 or whatever, all that's going to count. If you have a pension, all of that's going to count. Write that down. Any 1099s you get. So this could be interest or could be withdrawals from your IRA, all that. Write all that down. What typically gets people, Jessa, is they think that, well, I have some muni bond interest, so that doesn't count. Well, the IRS ain't gonna let you off the hook on that.
It's not that easy, huh?
So it does count as provisional income.
Okay.
So you write all of these things down, and that's the formula that the IRS will use.
Okay.
And if you are married filing jointly, okay, and you're under $32,000 in that calculation, which that's kind of hard to do, I would think.
Right.
Then there's no taxable Social Security, so you don't have to worry.
Okay, well.
That's kind of a low number. Okay, if you're 32 to 40,000, up to 50% of your Social Security could be taxable. And if you're above 44,000, up to 85%.
And that's a joint number you're talking about.
Yes, that's
there.
the joint numbers. We'll put the single numbers on the screen, and you can see that as well.
Okay.
But, if you think about it, our example, we're getting 40,000 in Social Security. Half of it's taxable would be 20. And when it's taxable at my highest tax rate, whatever tax rate I'm paying, whether it's 20, 22, whatever. So you can really quickly do the math.
Okay, no, that's a great exercise for folks to do. You have rental income on there too. I don't know if you
Yeah,
mentioned that
sure.
bullet point, but lots of folks around here who have that, so that
Yeah.
counts in there too.
Sure.
You can take a look at some of these numbers, watch this back, do the exercise, and guess what? Good news for you. We have more. We're going to talk about more Social Security after the break. It's Lowcountry Money Talk. We'll see you after this. All right, welcome back in. This is Lowcountry Money Talk. To our viewers who are with us on the first part of this show, we're talking Social Security. And for those of you who are just tuning in, we're still talking Social Security, so you're in luck.
Finish it up. Yes.
Phil Bloyd's here. He is with Revolutionary Financial Group, and it is nice to have you.
Thanks.
And boy, this is a big topic we're talking about today.
We can make some big mistakes here, so we need to avoid them.
Yeah, that's why we have you, the expert, to
Sure.
help us navigate this one. Okay, we're going to start back where we left off, talking about Social Security, specifically about provisional income. All these different types of income that we've talked about and what this means for us. Now, you've given us some very good examples. And before the break, we did an exercise. You showed us, some of these brackets for those filing jointly. So what does this mean for us? Let's say we fall into a bracket where half of our income of our Social Security is taxable.
Sure.
Or maybe 85% is taxable. Walk us through
That
some of
hurts.
these numbers.
Sure. Okay, so here's what we want to we go back to the provisional. We did our totals. We figured out, okay, based upon, where all of my income's coming from, half of my Social Security is taxable. Okay, when we say half is taxable, now a lot of people confuse, okay, I'm working, dollar pay, I'm not talking about all that stuff. I'm talking about we're retired, we're receiving Social Security, we're not working outside that or anything else. How much is going to be taxable? So we came up with 50%. It doesn't mean that it's taxed at the rate of 50%.
Okay.
So let's see our example, go back to that. So we determined that we were getting jointly $40,000 a year in Social Security. We determined that half of it was going to be taxable.
Right.
Now we have to determine at what tax rate, income tax rate, okay? So really quick, the tax charts. So when Social Security is taxable, it's going to be taxed at your highest income tax rate.
Okay.
So let's say, Jessa, that your highest income tax rate is 22%. That means that the IRS is going to want about $4,400.
Okay. So there's really two equations we're working with here. First, we got to determine how much is taxable, and then this rate here is what you're talking about. So you can basically, math your way into exactly what's coming out.
Sure.
Yeah.
And, if we look at 85%, boy, that's a whole nother level. So then use our same example. 85% of our $40,000 is $34,000, taxed at 22%, $7,400. Now, a lot of people, especially when they first retire, they do not think about, hey, my Social Security is going to be taxable because it came out of your check when you were
Feel like
working.
they already got that, right?
Right. So they took over 7.5% out, and then your employer matched 7.5%. Now the IRS says, well, hey, we're going to want some tax on that.
Got it.
So that can be sneaky.
Well, it's just good to have your mind around it so you know exactly, what you have to work with. For those who are out there retired now and thinking a little bit about all of this or maybe planning for retirement, let's talk about any income that you may be able to receive that is not considered as provisional income by the IRS.
Great point, Jessa. So there's not a lot of things, okay, but one thing that I'm always talking about on this show is income from a Roth IRA.
Yes.
That does not count as provisional income. And when we do our conversion from a traditional IRA to a Roth IRA, it is going to count the first year. But after it's positioned in that Roth IRA and we take funds out of there, it does not count as provisional income. So it's important that we use that as a tool to get that money moved over.
Good to know. You mentioned on the break briefly too, life. Possibly having an insurance policy there. That one's a little bit, there's some gray areas, maybe some stipulations, but maybe another way
Sure.
have some provisional
Well,
income
some life
benefits.
insurance policies, if you're using these for retirement means and they have various loan provisions and things, if we follow the IRS rules there, that may also not count as provisional income. So that would be another great source. You know, we always talk about where are we going to take our money from, you know, so it really makes a difference to determine what is taxable.
A huge difference, and that's where having somebody help you navigate some of this stuff, guide you through these, because it's a lot to understand and keep track of. So speaking of a lot to understand and keep track of, we're going to talk a little bit about the stock market. On the other side of this break, try and unpack that a little bit for you. We'll be back with Lowcountry Money Talk. Hi there, you're returning with us here on Lowcountry Money Talk. We're glad you stuck around because we have a big topic for the back half of this show, unpacking the stock market, what's happening, it's volatile, and thankfully we've brought in expert Phil Bloyd, who's sticking around to help us with this one. Nice to see you, of course, with Revolutionary Financial Group.
Right.
What do we do here? We're watching we've got inflation, we've got up, we've got down, we've got, you know, a potential issue with Russia maybe invading Ukraine. That's causing more volatility and plummets one day and maybe not the next. So I guess the question is, are we in a bear market? What does all of this movement mean?
Yeah. Well, I mean, there's all kinds of technical ways to figure that out. But as far as a bear market, I mean, we're due for one anyway. So maybe this is just the catalyst to put us there. Because if we look at our chart here, I have a little chart we'll put up. But, you know, this is a long bull run here. So this is 100 years of the market. This is a few years back, and this is what we're currently in. If we take the COVID out and extend that, we've had a heck of a bull run.
Absolutely.
You should have made a lot of money over the last 12 years,
Let's
I would
hope
think.
so.
Now gets the tough stuff. So we got these little bears that come in between, okay? So I did notice, and looking at some things over the past few weeks, that if we look at the NASDAQ index, most people say that's a techie thing and all that. So if we look at that index, I think what I heard was about 50% of the stocks were already in bear territory, meaning that they were 20% off their highs.
Wow.
And in the S&P index, S&P 500 index, about 30% of the stocks there were already off 20% off their highs. So technically, you know, maybe the index isn't bear, but many of the stocks are. And I tell people, I say, I think those stocks are there waiting for the others to join them. Okay. So, you know, it's been volatile, you know, and we had a really good day. This information about Russia and back, I think that maybe Russia's just using that to move the oil prices up.
Interesting.
Because they're like a 70% energy economy.
Right.
So the higher the oil prices, the more money they make, right?
Maybe this is all just strategy for
Could-
pricing. I mean, who knows? It's
Could
hard
be.
to know. Okay, but at any case, the folks who are at home are wondering probably at this point, how do we plan for this? How do we cope with this? How are we in the right risk category?
Well, you're going to find out with your portfolio now if you're losing sleep that maybe you're not allocated in the right amount of risk versus reward, or maybe you're too aggressive. So we're going to have some time here where the market really moves back up. You know, you'll go down, you'll move up, you'll go down. So I really would not like personally to sell anything when it's low. You don't want to buy into the fear. So what you want to do is you want to have a good strategy to say, okay, maybe I'm a little overly aggressive and I need to pull back as a percentage. And when these stocks move back up, maybe you do your pullback then, is what I would say. You don't want to solidify your loss and sell low. You know, that's kind of goes against it. But a lot of people say, you know, when does the next bear start? I mean, I think we're moving towards that. Now, typically, historically, we may have a nice run up before that bear kicks in. So if we have that nice run up, you want to take advantage of it.
Well, that's exactly what I'm seeing when you're talking about this 100-year history here is it's pretty much traditionally what has happened. So if you're just going on statistics,
Right.
that's probably where we're headed. So it's good to know how to plan for that, you know, with all of the volatility. We're not going to solve the question about the Russia-Ukraine conflict today, but we may solve if we're in the right risk categories just by talking to an expert. So it's important to know
And
that.
adjust that as it comes up. One statistic I'll give you here, if the market goes down and my portfolio is down 40%, I'm gonna have to have a 67% return just to break even. So if I'm averaging an 8% return, it will take me over 6 years just to break even.
Okay.
So now is the time, you know, as we get these upswings, it's really time to get your portfolio in order
Right.
for the time coming, you know, ahead.
And keep your head grounded too, so you don't react too quickly.
No knee-jerk stuff.
No, yes, and sometimes that's where you come in is almost a therapist, keeping us grounded, right?
Remember, Jessa, fear and greed move the market. So we're in the fear now. The greed will come later, and people will say, I need to buy it so cheap, and then it'll move. That's how it goes.
We'll leave it right there, but we have more after the break. We are back from break with more Lowcountry Money Talk, and we have had, well, I'm going to say some fun on this show so far, Phil.
Sure.
What do you think?
I like it. You know, we got to keep it a little light but informative as well.
It is. It's incredibly
keep it
informative.
going.
In fact, my notes are piling up on me here as I'm learning from you. But we were talking about Social Security earlier in the show. We've just recently flipped to really talking about current events and the stock market and what this might mean for you, especially if you are retired or nearing retirement. A couple of the things we've touched on here, obviously, is, you know, the Russia situation pushing up gas prices. Everyone's talking about gas prices.
Sure.
We're all talking about inflation. You know, we just had our Super Bowl parties. The meat was more expensive. The alcohol was more expensive. Getting in the car to go to
Yeah,
the friend's house
sure.
was more expensive.
Absolutely.
So talk to us about that. What is this meaning
Well,
for us?
there's a lot of things that are kind of waning on our economy now. We have the inflation, which moved up to 7.5%. That's the biggest number in like 40 years. The producer price index even over 9%. I think it was like 9.5 or something. So this is what you're going to see now. Many of these manufacturers, they've been kind of eating some of the costs to try to keep it down. They're not going to be able to do that much longer.
Yeah.
So they're going to be passing those prices on to the consumer. So you're going to see that. You know, we've really had a sputtering economy. So as people start going back to work, we're going to need more energy, you know, more oil. So, you know, we're looking at gas prices going into late spring, summer, you know, over $4 a gallon pretty much.
Wow.
So that's a huge number. And, you know, I've seen different numbers on inflation, who knows, but you're also looking at the Federal Reserve. They're going to start raising interest rates in March. So we don't know if they're going to start at 0.5% or 1/4% or what it's going to be. So there's a lot of uncertainty about that and how many rate hikes go along. To control inflation, you know, there's an old rule that says, hey, you know, your interest rate needs to be above your inflation rate. Well, that would put us over 7.5% interest. I don't know that the economy is going to like that.
Yeah, and those are tough things to sort of manage. You've got, you know, obviously the highest inflation in 40 years, as you mentioned, and then if we're also battling, you know, rising interest rates, that puts us in a tough position. That being said, we're going to go with the glasses half full today.
Okay.
We're going to talk positively.
Okay.
Because there are actually some things that are moving in the right direction. We talked a lot about, you know, the potential of a bear market and some stocks plummeting as much as 20%. There are some things moving up.
Well, let's look at it like this, Jessa. If I have my powder dry, and I've anticipated this a bit, then I have money to invest in the market. What better time to invest in it if we go back to our chart and we say, hey, what if we would have invested in the last start of the bull market and we ran it up for 13 years? Boy, how much money would we have made?
Right.
So we need to be ready for that to start the buying, you know, especially if we've stashed some cash away. With retirees, it's a little concerning because You know, they're not saving, they're not working, so they're not contributing to retirement, 401ks, whatever it may be anymore. So their money has to last. So if they don't have it invested properly and they're going to take it all down, that's a little scary.
Right.
You know, we have a software that we use. It works typically for people that have over 500,000 for retirement assets or something to invest, and it's a risk assessment. And, you know, anybody that's watching the show, if you want to contact us, you know, we can have you come in. You'll also get mailers from us as we do local events. I would say be sure to come out and listen to some of those events. We go a little bit longer into some of the things we're talking here, don't have time to get into. So be sure and take advantage of that. But in the short time we have left, I would tell you some things that I've noticed that have been moving up in an inflationary environment.
Okay.
So in an inflationary environment, I've noticed that of course, the oil companies, I mean, that stuff's been moving up quite a bit. Commodities, of course. I've also noticed recently gold, you know, your gold, your silver, your metals, those have been moving up quite a bit.
And that's one that we discussed on a previous episode about how poorly that had been doing. So that's interesting to see.
And now this is the year for it.
Yeah.
And also food stocks. So if we have food companies, you know, those stocks have really been moving up as well. So if you have any of those in your portfolio, put your eyeballs on them and see if I'm right. They've been moving up.
Absolutely. Okay, well, you heard it here on Lowcountry Money Talk. Lots of good expert advice, and you know where to find more. If you want to get that risk assessment and analysis, you can reach out to Revolutionary Financial Group. And if you want to watch more Lowcountry Money Talk, you can see it right here on WHHI. We'll see you next time.